everyone, welcome to Foxon Media Digital. My name's Amy and today I'm joined by Ross LeBlanc, who is Product Manager Innovation at SimCorp NA. So welcome Ross, great to have you on the channel.
Hi, good morning.
Yeah, thanks for joining. Of course, you're one of our event partners, so we wanted to have a little feature of you on our channel. So first, could you tell us a bit about yourself and about your company?
Sure. So I'm the product manager for alternatives here at SimCorp. I've been working with the teams for the past six and a half years now to extend our existing alternatives capability. So I've been in the industry for about 15 years now, coming from the vendor side. So happy to have a discussion about what we're seeing in the market today.
Yeah, absolutely. Tell me about some of the most significant and emerging trends in the alternatives market, because we don't often talk about that on our channel. So it'd be good to get your insight. And how are these trends impacting investment opportunities?
Yeah. So I guess taking a step back at a high level, we still think and see alternatives as being a very attractive asset class for investors. More and more they're using it as a form of generating higher returns to protect against inflation and also ESG alignment, which is a topic and a trend that we're seeing more and more of. But the past couple of years, the pandemic definitely turned some of the business practices upside down. We've seen a lot of investors take a wait and see approach to alternatives and increasing their allocations. So, for example, a recent InvestOps survey found that I think it was about 68% of investors said they plan to maintain allocations to alternatives, and 26% plan to increase allocations. And I mean, if you flip that around, what that really means is about 6% of investors plan to decrease allocations over the next 3 years. So there has been a short-term cooling off that does continue to linger, but there are definitely indicators that things are changing. So I guess overall, at a macro level, the money is steadily flowing into the asset class. In our experience, we see existing investors increasing allocations to alternatives generally, and this is a trend that's continued for the past 20 years or so. So an interesting fact that we've observed is it took maybe 30 to 40 years for alternatives to reach about 8 trillion in AUM by about 2015. And within a time span of just 11 years, so from 2015 to 2026, that number is basically going to triple to about 23 trillion in AUM. So we're seeing significant continued growth. And some of the asset classes are quite stable. So if you think about hedge funds and real estate, and others are heating up. So private debt and infrastructure, for example, private debt alone has seen 10% year-on-year growth for the past 10 years. And overall, alts is expected to be about 15 to 20% of total AUM by 2026. And that's certainly in line with what we're seeing, where alternatives are just another part of the traditional asset mix, right? They're being treated and streamlined alongside traditional asset classes. And this also extends to ESG. We're seeing some large investors and managers have a significant focus on ESG, and by 2026, it's expected to be about 25 to 50% of the AUM, including some element of ESG. If you add alts and ESG together, we're talking about 60% of total global assets touching on those two topics. And I guess the last point in trend I'd like to mention, of course, with the SEC's release of the new ruling on private funds just last week, we do think this will have a significant impact on the asset class as a whole. It'll increase transparency, accountability, and generate some efficiencies, especially with regards to the reporting cycle. So overall, there has been some short-term cooling off the past couple of years, but we do expect and do see long-term continued growth for the asset class with a strategic trend towards asset class consolidation.
Yeah, absolutely. Some great insight there. So thank you for that overview. And a lot of them are long-term investments anyway. So it'll be interesting to see how this pans out in the coming decades, especially given, the push for ESG and all of those other factors that you just mentioned. As we know, alternatives can be very complex. So when it comes to technology, what key components are crucial for supporting informed investment decisions in this space? How are you helping navigate that?
Yeah, I'd like to take a step back. I think success here is bigger than just alternatives. I really believe that the critical component is a core cross asset operating model. So at SimCorp, the number one overall challenge that we see is a fragmented operating model where you have, sometimes 100 different systems, over 100 trying to talk to each other. in this type of fragmented operating model just does not scale. It's got a high cost of total cost of ownership. It's got a lack of a golden copy. There's a lot of manual workarounds and duplication of data entry. There's a lot of reconciliation measures that need to be put in place. So there are a lot of challenges with that. And to be clear, nobody plans on this. No one starts out, planning for a really complicated, fragmented operating model. It's something that just tends to be acquired over the years. But building on what we just discussed, if if there are changes and if you are expanding allocations to certain asset classes or changing strategies, it just lacks any type of flexibility to adapt to that type of change. So, when there is change, like we've seen the past couple of years through the pandemic, it carries considerable cost to adapt. So with alternatives becoming just another part of the traditional asset mix, we believe it's really important not to miss the forest for the trees. So alternatives must be considered alongside traditional investments for a more holistic approach to investment management. So overall, I really do think that the starting point and success within alternatives is actually much bigger than alternatives, if that makes sense. It's a critical component that's often overlooked. So you need to have a strong foundation to build your business, which includes alternatives. So I guess just a few quick examples. Mixing traditional or listed and unlisted investments on a cross-asset platform where you can run cross-asset compliance checks on sector or currency exposures, check cash positions in real time, including alternative investments, centralize your settlements or payment structures. You can really only do this with a core cross-asset IBOR, investment book of record, ABOR, accounting book of record, and now EBOR, the ESG book of record. You can only do it with those three things to effectively run your operations and then scale your alternatives business. So you need the right foundation in place, focus on the big picture. Otherwise, we find clients tend to get bogged down in Excel spreadsheets and manual workarounds that are, they work for the time being, but ultimately don't allow you to scale the business.
Yeah, no, it definitely resonates, like you say, with those wider trends about, we're seeing public, private alternatives being consolidated in businesses. And also, this has a knock on effect on their operations and their data set. So it's about thinking holistically about all of this. So certainly having that operating model in place sounds like what we're hearing from other people in the industry too. And when it comes to getting a competitive edge when expanding into alternatives, what would you say to this? Like, what's your approach and what would you advise people?
Yeah, so just to reiterate, I mean, focus on the core operating platform. That is really the heart and soul of your organization. Once that's in place, then you have the luxury of focusing on the competitive edge. So some of the most advanced clients I work with, they're really continually trying to improve their operations and really push the envelope of what they're able to do. They just do not accept the status quo. They don't accept that alternatives are manual. They don't accept that key strategic decisions should be made on valuation data that's 3 to 5 months old, for example. They don't accept that they can't accurately predict cash flows, NAV exposure, or risk and liquidity as required on demand. They really want to do much, much better than that. So there's a lot we could talk about here, but I want to focus on one kind of core key item, which is data. So first, what to collect, how to collect it, and then how to exploit that data. So the first one, what to collect. I do believe investors need to focus on actionable data, data that really has a purpose, has a use case. There has been a trend over the past couple of years where we see clients in the market and investors generally just trying to collect as much data as possible with honestly not knowing necessarily why they need that data. There's just this FOMO, the fear of missing out, and they truly believe that they need it for a future use case that they may not have in place today. And that's fine if you have the foundation in place, if you have the core cross asset operating model in place. That's fine, but if not, you really need to just first focus on actionable data. So the first one would be look through. That's a really great example. So I still speak with a lot of investors who don't collect this data for a number of reasons. It's too complicated or they don't think that they can get it. And that type of pushback, I totally understand. It's a really highly manual process. It's really complicated to collect that data. I mean, if you have 100 private fund investments, that could easily be 20,000 to 30,000 data points that you need to track at the underlying level on a quarterly basis. So it's a huge burden, but the value you can get out of that data is critical to a competitive edge, I believe. So, for example, if you invest in private market funds, you can't just stop at the fund level for exposure analysis. It really tells you nothing. A fund could be invested across multiple sectors, multiple geographies, currencies. So stopping at the fund level when you're looking at exposure, it really does not get you very far. Look through really gives you the ability to accurately view exposure. So if you have a cross-asset portfolio, and so if you're combining all this data in a cross-asset portfolio, it's 100 times more powerful than that. So the question I typically pose in this scenario is, if you ask an investor, like, what is your total fund exposure to the energy sector? Sounds very simple, but if you think about it, you need to go at the decomposed level across publics and privates, down to the very bottom level. And it's a really complicated thing to do. I talked to one client about that, and they said it would probably take them 4 weeks, 6 weeks to put that total report together to normalize all of that data. We believe it should take seconds, not weeks, to answer that question. It should just be there in real time, on your screen. So that's the first point. I think the second point then to get a competitive edge is really focusing on efficiently collecting that data. And there are a few options here. So we've been exploring the past couple of years AI and machine learning and how that could apply to alternative investments. We now have 3 clients live leveraging AI and machine learning technology to automate the collection of private market data. A year ago, a year or 2 years ago, I constantly encountered investors who just didn't believe that technology was capable. But I mean, with the past 9 months now, with the rise of ChatGPT and Google Bard and all these other tools, everyone just knows that it is possible. It is the right technology to collect this data. So, in the absence of global regulation and standardization of alternatives data, I truly believe this technology is the answer to processing unstructured alternatives data. So that's kind of one of the first options. I think that is definitely the future and how things will just be going forward. But also, you can leverage a specialist service provider in a cost-effective way to collect this data for you. This just depends on where you are in your alternatives journey. So new investors, to the asset class may not, building out a portfolio, they may not have the resources in house, the expertise to collect and transform this data. Or, I have seen large investors who have the teams and the expertise, but they want those experts doing something better with their time. So it just really depends on the requirements of the clients, but outsourcing to a specialist service provider is certainly an option. These specialists, they have the scale, they have the expertise, they have the knowledge, they can help you remove a major pain point, which is the data collection. So one of our partners, for example, Colmore, in their case, a lot of the times they're better at getting this data than a lot of clients because this is the only thing that they do. They have highly qualified CFAs and CPAs focusing on transforming and normalizing this data. So that's definitely a trend we've seen the past couple of years. Clients streamlining operations and deciding what to keep in-house and then what to outsource in a cost-effective way. So that's getting the data. And then lastly, exploiting that data. So we see a lot of investors making key decisions on very old data, which really, really bugs me. So you get a quarterly evaluation. It's on a reporting lag. It could be 3 to 5 or 3 to 6 months old. And then you use that to make key decisions, strategic decisions, and that's no longer acceptable. So certainly to get a competitive edge, you need to challenge the status quo there. For example, the cash flow adjusted NAV, that's long been the industry standard. You take the last known valuation from the GP, which, yeah, it could be 3, 4, 5 months old, and then plus or minus any additional cash flows, and you make that adjustment. But what about going beyond that? What about a cash flow adjusted market value at the underlying level? We have more and more, we're seeing that clients are getting that type of data to be able to do that. What about a daily FX cash flow adjusted NAV, where we know FX rates, we know the movements? What about automatically adjusting bottom up to the top level, to the position level to get an FX adjusted NAV? So we don't necessarily know about unrealized movements, unrealized economic gain or loss, within a reporting period, but we do know the FX rate. So why not leverage that for a more accurate view of exposure? So simple example, we had a client who had exposure to Turkish lira. I mean, in 2021 alone, it lost like 40 or 45% of the value. If they had waited until the next report came from the GP in 3 to 4 months, they would never have been able to take action. You'd never be able to counter that type of loss in a timely manner. So there are, there are value. There's a lot of value in being able to action this data and exploit that data. I guess just to kind of summarize, the reason I'm pushing on data so much in this response is, remember a COO at one of our clients said something years ago that really just stuck with me. They were starting their journey to find an optimal operating model, and he said their first priority was to get their data in order. It's all about data, 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 and then that would serve as the foundation for them to build on. So to get that competitive edge, focus on the core operating platform. Once that's in place, you have the luxury of focusing on the competitive edge, and that largely for us revolves around data for alternatives. So long-winded answer, but yeah, there's a lot to discuss there.
Yeah, absolutely. We could talk for days about this because there's so much going on with alternatives. But I think you summarized it really nicely there. Start with a core operating model, think about what actionable data you need, and then depending on where you are in that alternative journey, think about outsourcing, thinking about leveraging new technologies to help you get that real-time information and make informed decisions. So I think that's been a really great insight into what's happening and how managers can best enter the space or improve their, oversight of the space. So thanks so much for joining us. And of course, your team will be on site at TSAM very soon, should they wish to learn more and chat with the team about this. But for now, Ross, thank you for joining the channel.
Appreciate it. Thanks very much.
And thanks everyone for watching. Don't forget to follow our YouTube channel for more content on challenges and opportunities in asset management, wealth management, and ESG. And don't forget to give this interview a thumbs up and hit the subscribe button.